Good morning and welcome to the Stuyvesant Square Consultancy, our report on fourth quarter 2018 GDP. If you're not familiar with how we do this, we show the last quarter 2018 Q4 in gold, the 2018 Q3, the prior quarter, in blue, and the last year's comparable quarter in red. GDP this month for the last quarter of 2018 was held up by the government shutdown, so the report was only released this morning. Let's take a quick look. As you can see, basically every sector in GDP declined as we had anticipated. In our third quarter report, the only one that showed some improvement really is a reduction in net exports. What we have been saying since Q1 of 2018 is that there would be a stacking and that there would be echoes throughout the rest of the year, and we saw that here. If you look at our prior report for the third quarter and in the second quarter, you'll see that we correctly predicted that there were anomalies in each of those quarters resulting from the very low first quarter GDP. The most obvious evidence of this stacking phenomenon comes here in the change in gross domestic investment. As you can see here in the second quarter, we had a huge inventory buildup, 2.33, which gave us a very good GDP print for the third quarter. But that was ultimately unsustainable because, as you can see, that inventory has not burned off yet, and as a consequence, we had a very small inventory build in this quarter. We did have some increase in fixed investment, which is good, but still we only printed at less than 100 basis points for the total change in gross domestic investment. The effect of the stacking that we've referenced throughout 2018 is also seen here in personal consumption expenditures. That declined 45 basis points to 1.92, but off a strong 2.37% Q3 in the second quarter, but also this third quarter was off a paltry 0.36% increase in 2018 Q1. So people were catching up with their spending in the third quarter and have cut back somewhat in the fourth quarter. With respect to the personal consumption expenditures, we expect that number to come in somewhere between 1.2 and 1.7% for the remaining, for the beginning of 2019, and to continue that way throughout 2019. Recent restraint by the Fed in tightening rates, we think will induce consumers to spend a little bit more. Over here in the change in net export, there's really not that much to mention. This number tends to be corrected all the time anyway. So take it for what it's worth. It's often subject to revision. I'm sure it will be revised in the revisions that we'll get later this year. As I said, we did not expect the strong performance of 2018 Q3 to continue. The PCE and GDI gains in that quarter simply were not sustainable. We were not at all surprised that GDP came in at 2.6%. That was our lower bound range. Earlier in the year, we jacked it up 10 basis points to 2.7% in light of a jobs report that was a little better, but we're not at all happy with the current state of the economy. We are particularly concerned, though, about the problem with the yield curve. It keeps narrowing, and the 10-year yield is well below 3% at this point. So we have considerable concerns. We do a analysis in quite some depth at a website called seekingalpha.com, which requires sign up, but it's a free crowdsourced website of stock recommendations and economics, what have you. So check us out in more detail there. We go into excruciating detail, and we also show some of the things we suggest in the way of stock purchases or shorts based on what we're seeing in GDP. We first post our charts both on jobs and on GDP at our website, StySquare.com. Under client advisories, if you tip down there, you will see a flash reports, and you can access the charts there first. We post it on our Twitter feed, which is at StySquare here, and then we post it on our LinkedIn page here. So if you would like to keep abreast of our latest information, I suggest you use the Contact Us form that will drop down this subscribe to our mailing list page. It shows the email, first name, etc. That will give you access to our monthly newsletter, the free content, and if you wish, you can also add the premium content, which is available for a charge.